Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, February 6, 2025. It's 3:24 p.m. Eastern Time, so we've got another little over half hour left in the trading session. My post analysis trade ideas have been light. It's a reflection of the fact we're in a trading range, as I mentioned before. You either actively trade it or as a typical swing slash trend trader, if you have a holding period measured in weeks to months, then you're going to have to wait for your pitch, and that's when this thing breaks. I gave you the levels the other day. I'll go over those again. I color coded them very simple, green and red lines on the stock futures that roughly define the top and the bottom of the ranges, and then a definitive break to the upside obviously will be hard to spin as anything but outright bullish unless that fails. Likewise, a downside break of the trading range, again, especially a solid impulsive break, again, unless it fails, is really nothing but bearish. And that will most likely determine the next tradable trend from these such trading ranges that we have. That's where the good trends emerge from. I'm going to start out, change gears here, do something a little bit different. I started to mark up a chart here there's a couple questions that I'm getting back to today since things are slow. Somebody asked me if the VIX is still an actionable trade idea. I said absolutely. I definitely think so. Even added to my you can read the post, and I give you a chart here. I'll cover the VIX in just a second. We were right coming up on that really nice support here. This is the futures. You can of course use any of the VIX track and ETNs. My preference happens to be the futures. But if you don't trade futures, I often share the various fixed ETNs like TVXY. There's a bunch of them out there. I'll get to that in a second, the live chart. Somebody mentioned XLF broke out. We'll cover it. I wouldn't call it a breakout. I mean, if you want to, I guess technically you can say a move to new highs is a breakout. But it's just been moving up. And I consider breakouts, when you have a well-defined chart pattern. Like back here, you had this big symmetrical triangle I highlighted. I guess I created that line back in late 2023, which is right here, right before we broke out. And that was these are also similar to the trading range we're in the market. Symmetrical triangle patterns are, I consider them at least indecision patterns, and they can break either way. And then when they break, that determines the next tradable trend. And I didn't mean to, I'm just updating this. I was going over the questions. I didn't mean to go into this analogy. I hadn't looked at this chart other than just what's going on recently. But there's a great example. So you can see you ping pong, and the only difference between we're in a sideways trading range right now in the market, SPY and QQQ. This was again a symmetrical triangle pattern, and this is what I call breakout. So there's an upside break, and you don't need to be an expert market technician to see that clearly determine the next tradable trend. And you can see when you broke out, you didn't look back. You had a trend that didn't stop. They didn't let the shorts out or the longs in until the first breather way up here. That was a rally of about 21% before XLX even had a little hiccup right there. And again, this is a trend that keeps going. So that was a powerful pattern, clear breakout. And now a swing trader an investor has been happy if they've been long since then, whereas a swing trader can gain a lot of updates on this. Pullbacks, they're all either single or double digit drops, all off the divergent highs. That's actually even another little divergent high there, another divergent high. So here's what I'm watching right now on XLF. As I've mentioned recently, there have been a couple comments on it. There was that primary uptrend line right there. We broke down following this divergent high right there, and we had this monster of a gap right there. Very good support. That's why I had it color coded. It's about $47, which is the bottom of that gap. Gaps once entered, as it was right here, are usually backfilled, and traders just love these gaps. I love them, and it's a great thing to incorporate into your trading, because more often than not, which is I like to say is far from always, but more often than not, traders will buy or sell when gaps are backfilled, the top or the bottom of the gap. So that's what they did. So they stepped in and bought it there. And when you had, at that point, a rally, they stepped in and bought the gap backfill to the button. And then we've been back testing, as I've highlighted since. We've been back testing the breakdown. So the breakdown's still in effect because we're still below the trend line. I often say the problem with back tests, when you short back test, is you can back test for a while. I like to see a rejection. We did get one there, but we're still back testing again. And the only thing I can tell you factually is the divergence that was in place back then has grown even larger right now. And that's it. There's a uptrend line right there. That's a little minor trend line that gives us this wedge right there. So if and when that breaks, and from the scope of the divergences in this pattern, it says we'll probably have a pretty good drop. But right now, the financials are in an uptrend. But again, as I go over, and I do this every day when I don't always get it. I analyze hundreds, sometimes over 100, hundreds of charts a day. Any given day, at least dozens. And I look at when I go into XLF, I look at the top components. They all look very similar to this big divergence. And you just need to get, solid evidence of a reversal, be it candlestick reversal pattern or whatever. I don't want to get too much into it. I just wanted to mention that that's what's going on there. So it is a marginal new high. But as I often say, breakouts that occur with negative divergence and overbought conditions have a much, much higher. They usually fail. Again, usually is not always, but it just means more than often, more than 50% of the time. In my opinion, again, it varies security to security, sector to sector, stock to stock, but I would say north of 70% that when you get these breakouts with similar technicals, the upside is limited before that breakout fails. All right, enough on XLF. Somebody asked about cybersecurity stocks, CrowdStrike and FTNT. They look like they're breaking out. All right, so this is the chart I started to mark up. I have it up. I'll just show you the live chart because I figured I'd share this for others of mine. So CWRD, was it? Oh gosh, what was that symbol again? CRWD. Yeah, what did I type it wrong? Said it and typed it wrong. Okay. All right, so keep it very simple. This is a weekly chart. So the stock, when you see the candles tail off, that means the stock came public back there. Started trading under this symbol. So what I see, again, a lot like the stock market, is a virtually identical technical posture to back in late 2021. And again, this is the kind of the core, the premise of technical analysis. It's my theory on how it developed. I've read a lot of books, but just somebody over time, people started noticing similarities in price action in stocks, even before the days of electronic trading and charting like this, and then notice those similarities to predict future results. What happened when you have these certain type of patterns formed, various technical chart patterns. And so this one, all I can tell you is just like back then, you have almost identical divergence. If you look at this period right here I have circled, the divergence is identical. The stock seemed unstoppable back then. There's absolutely nothing, and let me make this very clear. I'll highlight a bearish technical posture or pattern. There is nothing even remotely close to a sell signal in this stock now. So it's not a short right now. You need to get some type of sell signal that can come in various forms, be it trendline breaks, horizontal price support level breaks, breaks of key moving averages, candlestick bearish reversal patterns, et cetera, et cetera, et cetera. But all I can tell you, it appears likely and imminent that a trend reversal is likely, and based on the scope of the divergence here. This is a weekly chart, by the way, that I started out on. Based on that, I see nothing different than what happened last time. So from this point, from that divergent high, there was your breakdown. Then you lost the 200-day moving averages. Once you lose those beautiful 200 days, I know I hate sounding like Trump. I don't mean to do that by that beautiful thing, but that's what they are. And so many tech stocks, they just work so well for defining the larger primary trend. So if you missed the whole thing there, you were a non-believer, and you didn't want to short here when the sell signals came, then you had an opportunity to short on the kickbacks to the 200-day moving averages. This whole drop, before all was said and done, was 69%. So again, what do you look for? I'm not super crazy about this uptrend line, but it's similar to this one here. Same slope, duration, and then a break of the 200-day moving averages. And again, history tells this stock has a history of dropping. It's a higher beta tech stock. 70% is really very normal for higher volatility, higher beta tech stocks during bear markets. All right, so 50% typically a run-of-the-mill kind of correction or bear market, and again on a primary trend change when you get below those 200. So that's what it looks like on the daily. I'm sorry, the weekly. Here's what it looks like on the daily. Again, you can go down the daily, you get a little more granular. There's a divergent high. It doesn't look like much because all my charts are set in log scaling. Let me fix something here. It's bothering me. Let me de-highlight that volume at price histogram a little bit. All right. Taken away from my chart. So that's it. So little divergent highs and little trend line breaks give you little corrections, little being 24%. I think most people would welcome a 24% profit in just a matter of a week or two. 35% there, a little bigger divergent high. And then this is really DH1 and DH2 right here. This was the second because of much larger. The divergence expanded. Again, that's that same period I just showed you on the weekly, and that was followed by a 69% drop with two counter trend rallies that took you back to the 200s. And that ended with, you got it, a big old divergent low. Positive divergence, and that one should go across there. My line should come there. There it is. And that divergent low was the technical catalyst that launched this rally now that we're in. And then you had DH1, divergent high 1, shot across the bow. That was a drop of a correction of a 50%. So again, know your security. When you're trading and you're formulating a trading plan, there's nothing worse than being a flexible trader like me, going long short, and then let's say you're looking at something like this and you're waiting to position. Maybe you've taken a few shots that didn't pan out, and you get stopped out for whatever your loss is, 10%. When the big move comes, I've gotten better at this over the years, much better. I'll typically trade the counter trend moves within a bigger trend, but holding out for the juice, trying to, in other words, don't underestimate just how far a stock like this will drop once the primary trend changes. Okay, and that's so that would be your targets right there. Again, no sell signal. Well, kind of. If you look at it this way on the daily, we had a somewhat well, not super well, but somewhat well-defined trend line breakdown and a back test. So if it reverses there, fails that breakout, and then of course if it takes out the 200-day moving averages, it's going much lower. Okay, I don't want to spend much more time. Again, I'm just replying. Somebody asked on it. I don't have a position in that one. Maybe I'll take one later. I don't know. FTNT. This one, it's all here on the chart. It's just there for you. These are marked it up today. A divergent high, correction. Hold on, let me duplicate this. You can see my lines there, divergent low. This is swing trading. And these are, by the way, these are well worth it. It doesn't look like a lot because I use, and this is very, very important, log scaling. It is absolutely necessary, critical, especially on stocks or any security, whether it's a stock, a commodity, a bond. Well, bonds don't move much, but anything with large price differential. In other words, at the bottom of the scale is $11, upper part is $120 on this scaling here. Log scaling puts everything in percentage terms because a dollar term is irrelevant. When you have a $10 stock and it goes up $1, you just made 10%. When the stock's at $100, if you go up $1 a share, you only went up 1%. Massive difference. That's what log scaling corrects. So, and then you can see here that drop off that divergent high was 30%. And then you see a divergent low. Time to get bullish or long, cover, go long. And then you had a 248% rally. Ended with a divergent high. Well into the double digits. Again, simple stuff. Divergent high, drop. Divergent low, rally. Divergent high, drop. Divergent low, rally. And again, you can see the trend lines that define when you don't just short a divergent high because you have one, because it can keep going up until it plays out. Or sometimes what's even worse is stock keeps going up and then the indicators, the divergence gets taken out. And you no longer have it. So this one, I can tell you there's the trend line. It's not super well defined. But again, with these overbought conditions and divergence, wash, rinse, repeat. This is what trading, this is what technical analysis is all about, identifying similar technical postures and how do they play out in the past, and that's it. So this guy's zigzagging up. Yeah, the primary trend is bullish. If you're a long-term investor and you don't want to, you only want to make a few trades a year, You don't. This is, there's some takeaways. I do cover longer term charts, but we're swing traders here, and swing traders will sidestep these 30, 40, 50 plus percent givebacks that be honest, most investors haven't ridden this whole wave out. They were stopped out 10 times over on these pullbacks, which like I said, because most investors aren't going to give themselves a 42% stop loss or that's half their money loss. That was almost, again, a 45% drop. So twice you lost half your value in this stock. So what happens is long-term investors trade, they start stopping out around here. And then they wait till it's rallied and they think it's safe to get back in. They buy here, then they stop out again. So this is where swing traders can, get in and out, even if you don't catch the whole thing. And rarely you're going to get all of it. You just only have to catch a piece of those trends. And so that's it. So bottom line is, I wouldn't buy the stock right now. I don't see any buy signals or reasons to buy it. The risk reward is not attractive. I would wait for the next shorting op, and then before I buy it, I'd be looking for something similar. Pull back to support, ideally with divergent lows and or oversold conditions. Okay, those are your updates on those two, as asked for. Ford, do earnings pops or drops initiate a divergent high or low? They can, depends on the chart. If they do, then they do. I don't mean to be cynical about that. Not sure, but in Ford, I did look at it. I know they reported, I think it was yesterday. I saw them. They were down about 7% drops. Yeah, and I saw it at a divergent low. And I was going to highlight it, just like I've been wanting to highlight Intel, but I have just a bad feeling these levels are going to go. Ford's in a bear market. Okay, forget about the stock market. The stock market is all about technology. In fact, those two stocks I just covered, Crowdsource and the other one, they're tech stocks. Tech is a whole different animal, and there's an AI bubble we all know about. To what degree? Some think it's a bubble, some think it's a real deal. Again, we could argue that all day long. Only in hindsight will we know if it was a true bubble and how bad, and when it's going to pop, when it's going to end, and where it's going to go. But what we do know is tech, just about all things tech are doing well, most things tech. And a lot of the old real world or industrial stocks, tech companies by nature are much more efficient. Ford, you have legacy costs, a lot of people on the payroll, other issues. Either way, this is a stock. Again, you don't have to be an expert market technician to see this stock has been in a bear market, not just a downtrend, a bear market. It's dropped 65% since it peaked back when the last bull market in the stock market ended in 2022, and we had that correction. It has a divergent low, but it's been putting in these divergent lows. Actually, this one right now, I will say, this from here to here, this is the only divergence right there on the PPO. We had divergence building on the RSI for a while, which is getting bigger. And so all I can tell you, there'll be, and there always will be, bear market rallies, unless a company's going bankrupt, and Ford's not. There's going to be bear market rallies. They're going to be powerful. And at this point, you definitely don't want to short it. And you have some support. This is support. So yeah, I will highlight that. And I did note it, and I decided to pass on it. I was going to throw it out to you guys the other day. Somebody brought it up. I'll throw it out here. It's below the 200 days. It's in a bear market. And God forbid, when the stock market truly, not if, but when it rolls over, and again, I'm watching those red and green levels I'll get to in a second, we start breaking down and moving lower, these stocks that are already in a bear market, if Ford can't rally or if Ford continues lower in this super sized bull market we've been in, this is the biggest bull market in history, a la massive central bank intervention since the financial crisis, kept the pedal to the metal with zero rates throughout, near zero rates, artificially low rates, excessive stimulation, both fiscal and monetary stimulus, even at, when the economy and the stock market was booming. And so you have to ask yourself, what in the hell is wrong with Ford if this is what the stock looks like? So can you imagine if this is what the stock is doing in the strongest bull market in history, then what in the hell is it going to do in the next bear market? Who knows? Maybe it'll turn around and it'll be an outlier, but just be careful there. In other words, positive divergence, typically my kind of chart. at support or a little bit below. At least you want to see Ford snap back above this level here, 965. If it can take back the 200 days, look, it took them there and it rallied up real sharp. It was a bear market rally, but it was one to trade. There's the other, only other 2 times right here. We popped the 200s and you can see it rallied up here. These are double digit. You can measure them yourself. Here, I'll tell you what they were. It's easy to do. That was an 18% rally. These were all, high single digits, about 18, 20%. And that's about it. Bottoming play, yeah. If we're in some major super secular bull market that's just got a lot of life left in it, sooner or later Ford will most likely turn around. But that's it. I've spent a lot on there. So that's it, guys. Look, you can take it here if you want to be super speculative. It just made a new 52-week low today. Better bet is to wait till it regains these recent lows. You'll get some short covering, and then put your stop, set a stop just below the recent low at that point if you make the recovery. That way you're limited in your downside in case this thing does crap out. Okay, what else was in there? Okay, this is just a comment. I think I didn't see this before. Commentary. Get ready for tariffs to start increasing price. I just sent a letter. Oh yeah. This is, Trump's kind of getting checked in every direction. He's tried lately. I think it's losing some street cred. But with that being said, this is real. The talks of tariffs, yeah, it's the whole escalate to de-escalate thing, but we are seeing some escalations on both sides. And net, this I can't see how it's going to be spun as anything but ultimately inflationary to the consumer. And we all know trade wars are a zero-sum game. That's a well-known fact. So we'll see what happens there. Thanks for sharing that, Bud, about the price hikes. But we've been seeing price hikes for years, and I think the next wave of inflation is underway. Didn't mean to cover this one, but that just made me, why did I say that? This is DJP. I've long since used this as a proxy. It's just a broad-based commodity tracking ETN, very well diversified, overweighted like most are into the commodities that have the biggest impact on inflation, which is energy, crude oil, and all that. Of all the commodities, that's the biggest one. And, it's been moving up. And I've also used this for years now, sharing this with you, where I've made predictions on how the CPI is going to come in before it's released. And, I don't do it every month quite often. Some months is just we're moving sideways. But this is it. So this is what's happened since August of last year. You can see, again, commodity prices, which, again, are the best real-time proxy we have of inflation. Remember, owner's equivalent rent is, I believe, the biggest component. There's no real-time index for that. You can watch Zillow, you can watch the major markets, the national index. You can look at those are all, home price sales. They use, of course, not home price sales, but owner's equivalent rent and the CPI. But you can kind of get a gauge when the real estate market's still holding up or prices are not coming down on homes. You can guess that rents aren't really collapsing or going down much. And of course, there's that positive correlation there. All I can tell you is this is going to be this month's CPI, which is now over. I box them in and I show you from the first of the month. So there's where we started January right there. And there's where we finished January. And more so, and the reason I do these boxes, so I just take I can do the mental math on what was the average price. You can see in the beginning of January, we had prices were at the high end of where they were in December. This is a previous month right there. So we know that right there was going to be probably contribute, a little to the hot end of the CPI. But then right after the first few days of January, this thing just gapped up. There may have been, I don't know if there was any adjustment here. I'll have to look at some of the other, and I do. Sometimes these individual ETFs and ETNs will pay a special dividend. Some did recently. Most of them, that caused them to go down. I don't think this one did. I'll have to look to see what that is. That may have been a gap up in oil prices that did it. Oil's the biggest component. All I can tell you is prices throughout the majority of the month, and that's how I do it. I take a weighted average. I look, kind of see, this was a steady down, so you're really going to average right there. For this was a steady up, so you're really just going to split the difference there. This one, there were only a few days there. Most of your trades here on DJP were up on the higher end. So because of that, all other things being equal, in another week from now, when the January CPI comes out, I have to see where consensus is, but I'm going to expect it to be on the hot end. Plus, there's also a lag on some of those components, and you can see additionally for months now, prices have been moving back up on commodities. And of course, if it breaks out, you can see we're coming up on this previous reaction high. We break out, that's really going to start putting pressure on prices. And speaking of commodities, I'm still bullish the grains, still looking at a potential bottom in the grains, high double-digit potential gains, in my opinion, coming. We've been long wheat, corn, soybeans, and the likes for a while. They're not ripping yet, but they're certainly, I like what I'm seeing here. You've turned the corner. We had the bullish falling wedge breakout, then the back test. This is a daily chart. So you had the breakout, back test, steadily moving higher. Let me drop down to the 60-minute chart, that is. And there it is. That's that same wedge, breakout, back test. And it's zigzagging higher. This is what you want to see. It's all the early makings of an uptrend, near-term uptrend. And, again, when we break, this is a level I want to see taken out, like 550. And we'll probably start seeing an acceleration in prices there. Same with crude. Natural gas. We hit my 7th price target there. These are targets laid out all the way back here. Been highlighting this is long-term support. So we bought it here, went up, had a divergent high, sent us back down to where we started, hit the 5th target zone. Remember, you had 8 total targets given at that time. Then we've been moving up again. Once we took out T5, the previous highs, we opened the door to hit T6 right away. We gapped above it, hit it. T7, we put in another divergent high, sent us back down. That was the top of the basing pattern there, so we hit it and we're moving up. And so I still suspect we'll get that one last final thrust up, and that also aligns with my comparable price target on nat gas futures around 490 or so, a little shy of the $5 area. What else? Nothing much. Treasuries, like I said, if you're in it. If you're holding out for more, raise your stops. We hit that final target there, the 89.65. We're still there. It's still favoring a pullback to right here. Come in, backfill this gap, hit that uptrend line. Be my guess, and maybe more based on the charts. Long term, nice resistance here on the daily charts. So nothing crazy right now because we're still coming off. Remember, the whole point, we've been long since the divergent low. So the whole point is this was a long-term chart, could certainly carry for more upside. But again, just an idea. Take it, don't take it. It's another way to diversify a different asset class. What else do I have for you? I've been giving you updates on the equity markets every day. So there's nothing new there. We're still in the trading range on QQQ and SPY. You have my levels there, little minor trend lines here. And I gave you the kind of the red and green zone. Green, bullish if you pop the top of the trading range. Bearish if you break the bottom. Until then, it's a lot of noise, a lot of chop. The only other thing I would highlight for you here, some of the market leaders, Apple, especially Apple, remember, broke up here, sell signal 1, sell signal 2, hit the 200 days, bounced as expected, hit the trend line, back tested, rejected, still below the primary trend line. So bottom line on Apple, just a quick summary, and also broken down on the weekly chart, sell signal breakdown, back test, rejection, need to take out the 200s to open the door for more downside. Obviously bullish if it takes back the trend line. Let's not overcomplicate it. And then the other one I'd watch right now, well, Microsoft's continues to flirt with those 200-day moving averages, but below them, but not by a lot. You got to give it room, especially a solid. You got to see it start walking away from that. I think on the weekly chart, I have it out here. Yeah, you need to take out the recent, this is support down here. But it's the one that's been hugging the 200 days, like I've highlighted, and NVIDIA as well. NVIDIA, really, I would recommend monitor this one on a weekly chart. You got to see the majority of the Mag 7 or 8 stocks breaking below their 200s. Right now, you only have Microsoft a hair below, and NVIDIA is currently back testing. You remember, we didn't even break down last week. This is a candle. This is a weekly chart. The body is the fat parts where you close. So we closed right on the 200-day / 40-week moving average. So that really wasn't even a breakdown. It broke on the daily intra-week. And then this week, we're currently back testing the 200 simple right now. So let's see how this closes Friday. What you want to see is a weekly close down here, a red candle, a weekly close down here to say that NVIDIA has now taken out, or at that point, taken out the 200s. As of now, it's simply a test of the 200s. Intra-week drop, it was below it, I mentioned earlier, but it was just a day or two, and we're right back there now. And this is big resistance up there. If it can regain the 200s and regain 133.60, probably going to make another new high. As of now, that's not my preferred scenario. As I like to say, resistance is resistance until and unless taken out. So this is simply another back test to the 200 days from below, and you have price support there. And again, it's all on the 60-minute charts. 60 minutes will tell you go long, short, divergent high, sell, drop, divergent low recently, and this is rallying off the 60-minute divergent low. This is just the, the gyrations. It's a stock that's really just been grinding around like the stock market now for months. This one goes back almost a year. This is back in May, where we started in this big sloppy trading range, and we're right about smack in the middle of it right now. All right, guys, I'm going to wrap it up here, get the video out to you, and watch the close today. This has been Randy Finney with Right Side of the Chart. Have a good one.